The Fed has been looking for a cooler labour market, and now it seems it's here. Welcome to Market Insight. I'm Elena Casas. The US economy added just 175,000 jobs in April. That's far fewer than forecast and much lower than March's revised 315,000. The unemployment rate ticked up to 3.9% and wage growth moderated. Well, these are the kinds of signals Fed policymakers have been looking to see before they could talk about cutting rates. And markets have certainly taken this jobs report as a sign that a cut may be on the way. To dig into those numbers, I'm joined now by Andy Schneider, senior US economist at BNP Paribas. Andy, hi. What drove these numbers lower in April then?
Yeah, well, thanks for having me on, Elena. So look, I think that we economists, markets, forecasters have been looking for job growth to slow for quite some time now, but it's taken a while. We've had just months and months and months of upside surprises. So we finally got a bit slower of a pace. And I think, this kind of follows other indicators that have shown that labor demand has come down. We've seen hiring rates come down. We've seen job openings come down. So, we have seen a bit more subdued labor demand. I just think this is, the first time in a bit that we've seen that in the payrolls figures. So, as you said, it's something welcome for the Fed. It's not a complete surprise. And I'll say, too, that, this is a step down from just the kind of on fire pace that we've seen recently, but it's still a very solid report. And overall, still solid hiring and a bit softer wage growth. So it's definitely more of what the Fed wants to see here.
Do you think, though, that policymakers need to see a significantly less tight labour market in order to cut rates? And what might that look like?
Yeah, so this is just 1 month. So definitely policymakers need to see more data, a bit more of a trend. The key word here is confidence that the labor market is slowing down and really, that inflation is moving back to target sustainably. So they're going to need to see more. And I think especially on that inflation, front, the wage growth number here was good. But we're coming off a first quarter that kind of worried policymakers enough that they insert a sentence in the policy statement in the last Fed meeting that did flag that they're not getting the confidence from recent inflation numbers. So we think policymakers are going to need to see everything kind of really moderate in Q2. So we need to see inflation prints moderate. We need to see wage growth moderate. We need to see hiring moderate. And then we can start thinking about rate cuts. But we think that policymakers are going to be pretty careful here. I think there's still an easing bias, but they don't want to start cutting rates until they really, really have gained that confidence that they get the green light to do so, and they're not going to have to reverse course.
At this week's policy meeting, Andy, Jerome Powell was asked if the US is moving into a period of stagflation, given the weak growth in the first quarter and those sticky inflation numbers. What do you think?
I don't think so. I don't think so. I think, the economy is still growing at a quite solid clip. And, just those GDP figures, for example, the headline was a bit weaker, but that was just because net exports was, which is a volatile category. We just imported more than people expected. So you still look at spending numbers, and really what matters, just consumption spending, fixed business investment spending, those were still growing nearly 3%. So the economy is still growing quite fast. Inflation is still elevated, but coming down. But I think we're pretty far from a stagflationary environment. Even though once we get a little bit of wobbles here and there, and I even hesitate to call them any wobbles. This is just kind of a moderation of these very fast places. People might kind of throw out stagflation, but no, I don't think we're getting close to stagflation here at all.
What are you expecting for growth in the second current quarter? What's the US tracking for?
Yeah, I think we're going to keep moderating. So, like I said, final spending was around 3% to start the first quarter. So I think we'll come off that. We're looking for growth to still remain above trend. When we say trend is maybe 1.8 or so, we're looking at to kind of slide down in the low twos, something around there. And similarly, that should help continue to bring inflation down. So we still think inflation is going to be above the Fed's target this year. We think inflation is going to be above the latest meeting forecast, but still quite better. We're looking for inflation to probably finish the year, and this is the Fed's choice inflation measure, core PCE, probably around 2.8% or so. So that's improved from last year, but still says, we need more progress and is probably going to keep the Fed, we think, on hold through most of this year. We don't have the first cut until December.
Plenty of market participants, though, have changed their forecasts on the back of this jobs report to again expect 2 cuts. Do you think that the market moving with every comment that we get from the Fed, every data point, is really justified?
Look, it's possible. And I think, what this reflects is that the Fed is in a data dependence mode. So the Fed can give as many signals as it wants. It can try to really clarify its reaction function. But at the end of the day, the data is going to be what matters. And the Fed is going to move with the data. So, if employment really slows a lot more than we expect and inflation comes down more than we expect, it's totally possible the Fed cuts before we have it in December and delivers more rate cutting than we have this year as well. But if employment remains pretty steady, wage growth moderates, but still at a gradual pace, and then inflation also moderates, but at a gradual pace as well, like we have it, then I think the Fed's going to, stay patient, stay on the sidelines, and not cut until December. So at the end of the day, it's all about the data, and we think the data is going to be a bit more resilient through the rest of the year, and therefore we'll just have the Fed at just that 1 cut in December.
Andy Schneider of BNP Paribas, thank you so much for that analysis. Well, that's your market insight. You can watch more videos on Reuters.com.